Hi, wanted to give you guys an explanation for the essential question number one that was given on April 18th, 2012, and that's the spring of 2012. So this time you got yourself a food cart. I know you've all dreamed of doing this. I know I have, but let's go ahead and work through a couple of transactions relating to food cart. So we'll start off with question number one, which we'll, do in red, my mistake right there. And let's go ahead and we'll stick with it being red. Food Network highlights your amazing food cart and sales increased greatly. So this one gets to be kind of complicated because you know for sure you've got an increase in revenue and you've got an increase in expense because you sell more stuff. What happens to net income could be anything. It could be that your net income goes up, could be your net income goes down. It depends upon the relative size of these two, operating revenue, operating expenses. But the thing to remember is anything that happens in net income flows over and shows up in cash from operations. So to finish the example, what's going to happen from cash from operations, we don't really know for sure. Again, it depends upon the relative magnitude. You'll probably get credit for either answer. Next question, which will be in orange. So let's go ahead and make that one orange. Your business partner decides he hates food carts, so you can buy out his share with cash. Okay, so let's go ahead and cash this guy out. Basically what happens is that the firm loses an owner, and that owner goes ahead and gets all the cash that he had in there. So please note that we have this balance sheet equation working out. We had a decrease in assets and is equal to the decrease that we had in owner equity. So remember, changes in assets have to equal to the change in liabilities plus the change in owner equity. It's a rule. The other thing to remember is that changes in owner equity tend to get reflected in cash from operations. Cash from finance over here. So we've had this cash flow out, and because it's a change in an owner equity, we know it's going to be a decrease in cash from finance right over there. So the next question, which we'll go ahead and change to yellow, you buy food cart supplies from a wholesaler on credit, okay? And this is intended to be inventory stuff. So this is a transaction you've probably seen before. You've got an increase in inventory. You have done this on credit, so it's balanced off by an increase in liabilities. The balance sheet balances, but now if you remember, there's no apparent net change in cash. The secret is that there's actually an outflow of cash and an inflow of cash. The outflow is because you bought the inventory. So if you bought the inventory alone, you'd see it just, oh, there's a decrease in cash from investment. Because at the same time you're borrowing money, you see an increase in cash from finance, and that's the part that nets itself out, so there's no net change in cash flow. Now remember, you don't have to make the cash flow statement balance in every single transaction. In this one, it just did because that was the nature of the transaction. Moving over to green, try to make time for family, decide not to open your food carts on the weekend anymore. So we'll do that one in green. And this is one where you know that your revenue goes down, you know that your expenses go down, but you don't know exactly, what happened to net income. It could actually go either way. Same thing over here. So this one right here is like the opposite of question number one. You have decreases in revenue and expenses, but no idea about the changes in net income. But in either case, it flew over and fed into cash from operations. Now let's go ahead and move over to question 5, which we'll do in blue. Food inspector fails you, causing you to spend cash cleaning your food cart and purchasing a new operating permit. This looks like some increases in expenses. And what this question is really about is sign convention, making sure that you see that increases in expenses are actually something that's positive, which results in decreases in net income flowing over into cash from operations. So it looks like this one's kind of heavy on the income statement. I think the previous one was heavy on the balance sheet. Let's go ahead and jump over and do some purple or light green or whatever it is. Okay, regular customers hear about your dirty sanitation problems, decide to eat elsewhere, causing sales to fall. Ooh, bad. So what you have here is a decrease in revenue, a decrease in expenses, but you don't know which way net income goes. It could go either way, and that's going to be reflected over into cash flow. So again, let's go ahead and move over, and we get a color I know, which is purple. Seeing your business is failing, you sell your food truck and equipment for cash. Okay, so what's going on here is we're taking some assets and we're turning them into cash. So there's the decrease in one kind of assets. That's the food truck, that's the fixed asset. And you're going to see an increase in another kind of asset, a current one, that's cash. So please note that balancing on the balance sheet happens right there in the balance sheet. Nothing complex about it. Because we have a change in assets, that gets reflected in the cash flow diagram, and it shows itself as an increase in cash. Remember, it's cash flow from investments. It's not change in investments that we're looking at. And so because we sold it, we ended up with cash flowing in, and that's where we get that sign convention, positive inflow that's there. And then finally, let's go ahead and switch over to black for the last one. You pay off a zero interest loan from your parents with cash while considering what your next business venture will be. This one's fairly easy. Assets decrease, liabilities decrease, and cash from finance decreases. Remember, the loan payment would be a little bit more complex if we had interest on it. We keep it simple in this way. So there you go. There's an explanation for the essential question number 1 that you had on April 18th, 2012.